Equities and fixed income are both off to a solid start in 2026, although not without some bumps along the way. U.S. midterm election years are often volatile, so distinguishing the root cause, politics or fundamentals, will be important. Outside of Congress, America is going through other changes as well. President Trump has nominated the next Fed chairman. Although met with mixed reactions, we believe Kevin Warsh could help preserve the central bank's credibility if confirmed by the Senate. This idea of independence has been top of mind for investors. If the Fed loses it, or if markets think it's at risk, confidence goes with it. Warsh's appointment does help to address one uncertainty. He's likely to be more supportive of interest rate cuts in 2026, but in a responsible manner. But some questions remain unanswered. On the other side of the ledger is whether he plans to shrink the Fed's sizable balance sheet. If mishandled, long-term yields could respond negatively and push mortgage rates higher. Closer to home, interest rates are likely on hold for the foreseeable future. The Bank of Canada believes they've done what they can to support the economy, and that further cuts could rekindle inflation. Central banks carefully weigh monetary policy decisions based on economic reports and forecasts. It's not an exact science, but it is backed by hard data. Introducing an unknown to the equation complicates their job. The potential renegotiation of the Canada-US-Mexico trade deal is difficult to plan for. Any changes to the agreement could drive the Bank of Canada to action, but that's further down the road. Against the backdrop of tight credit spreads and suppressed bond yields, future returns may be limited to the income earned on these more conservative securities. Volatility has been most pronounced in North American stocks. Precious metals and technology stocks make good case studies. While the Magnificent Seven and AI-adjacent companies drove returns in recent years, that level of growth comes with lofty expectations. We see a number of cracks beginning to surface. First, hyperscalers continue to spend hundreds of billions of dollars on the build-out of AI infrastructure. Like any investment, they'll need to generate an appropriate return to justify these costs. This path to profitability is a key question for investors. The underlying infrastructure is a vital enabler, but it's not the monetizing force of AI. Companies will need to develop applications with real-world use cases for both enterprises and consumers. Second, Anthropic recently launched an AI toolkit that sent software stocks tumbling, likely an overreaction, but it's still a good illustration of the threat facing legacy tech applications. If AI is as transformative as we believe, change is bound to create both winners and casualties. Third, the supply of energy may not be up to task. While raw materials are abundant, refining, generating, and transmitting it across an aging grid is already a difficulty. Data centers and digitalization are only inflating electricity demand, as well as the challenge to meet it. On January 30th, gold and silver suffered their worst one-day declines since the early 80s. While President Trump's Fed nomination appears to have kicked it off, the sell-off was more likely a sign that prices had soared too high and too quickly. This illustrates another risk of investing in hot market areas. How quickly they climbed, fell, and came back shows how easily investor sentiment can swing. With all of this in mind, it's not surprising to see market leadership shifting. Sectors such as energy, consumer staples, and industrials that lagged in recent years have suddenly leapt to the top. This marks an improvement in market breadth, which is the concept of how widely gains are distributed. Overall, broader performance is a healthier investment environment, allowing more businesses to participate in market appreciation. Although it took time, the benefits of lower global interest rates and potentially improving economic conditions are beginning to work their way through the system. At the time of recording, we're barely a month into the year, but this rotation is still a promising sign as market concentration retreats and diversification steps up. Bellwether's global investment approach and core dividend growth strategies have shone. Looking ahead, we see the pace of corporate earnings growth as a key driver of returns throughout 2026. Meeting market expectations may be a tall order, but with AI-driven productivity enhancements to expand profit margins, it's not out of reach.